Allison, is sort of I know as ValueAct is sort of stock picker centric. What's changed for you guys over the last 18 months?
Well, I think the way, as you were saying, ValueAct Capital is an activist investing fund, and so we are long only, highly concentrated long-term investors. So for us, mitigating business risk in terms of investment thesis has a lot to do with the business quality, underlying business quality. And at that point, once we think that we are invested in companies with high business quality, then it's up to us to try to maximize returns within those businesses. So it's a very different sort of approach to investing, and a very different approach, therefore, to risk than some of the other points that have been raised. I mean, although that's the case, I think Jim said this, and I would reiterate that we have certainly gone through in the last 2.5 years actually, and really looked at our investment strategy, how it is we look at these firms. We've paid a lot of attention to the investments that we've made and the activist campaigns that we've had, and working within these boardrooms, which is what we tend to do. What's worked, what hasn't worked, what can we learn from our past lessons. So on the investment side, I think that we've really spent a lot of time putting into place a real sort of self-analysis that maybe wasn't as big a part of how we looked at our investments in the first few years. But I guess I'd like to answer your question slightly differently, and what's changed for us in the past 18 months. And one of the major things that we've done in the past 18 months or 24 months is look at our investor base, and we've said, well, what can we do for them? We had a one-size-fits-all sort of investment strategy for our limited partners, and maybe that doesn't work. Maybe some of our investors need more liquidity. Maybe some of our investors want to match the term of our investments to their lockup. Some are willing to have a longer lockup period in exchange for much lower fees. Let's look at our fee structure. So we actually spent a lot of time on that side of things, as well as obviously operational back office stuff, the investment stuff that I just talked about, but really trying to figure out how we could make our fund better match and better align with the interests and the some of the pressures that some of our investors were under.
Yeah, I was hoping maybe, Jim, to go back to something you said on sort of policy mix, and I'm sensing there might be some strong opinions on where the current state of that. I mean, do you find that in your interactions, people understand policy mix now better? Is it do you there's been this idea that policy mix in some cases is broken, or people are looking to sort of outsource that expertise? What would you agree or disagree with any of that?
Well, certainly policy mix is a big issue, and it does find its roots, I think, in the fund governance of institutional investors. By policy mix, I'm referring to a variety of strategic investment policies, such as the classic total return policy that's typically 60% equity, 40% fixed income, or some variant of that. Policy mixes that are getting a lot more airtime these days for certain types of investors who have to kind of identify themselves. Like, is this appropriate for me as I move from maybe what hasn't worked, like LDI or liability-driven investment strategies that pension plans, particularly those with closed funds, might want to consider. Real asset type strategies focused on inflation strategies, where endowments that are more sensitive to the inflation risk might need to focus more. And of course, there's always been the competing Yale model, which has delved into the illiquid space a little bit more than others. And then there's policy response, perhaps like what Edgar was talking about, like a risk parity approach with or without leverage. I mean, I think that's a debatable issue. Why I feel concerned about leverage in the policy mix is because of the issue of fund governance, the ability of the board, whether a public fund or an endowment, to stick to the strategy when things are looking bad. After 21 years at Callan, I've seen the song played over and over, just a different set of lyrics. where it might have been real estate in the early 90s. Everybody getting out of real estate. Oh my gosh, it's an illiquid strategy. Let's get out. Convertibles in the early, I remember a time when convertibles were thrown out during a period of poor performance by a board that didn't really understand what convertibles were. And then global macro strategies during the mid-90s when it didn't really have a strong policy or strong performance. They were thrown out primarily because the board said, I don't understand what these guys do. They don't tell us. So in a sense, they miss the opportunities of 2000 or whatever when there's a renaissance in these strategies. And more recently, we've seen emerging markets in the late 90s and value in 99 get tossed out and then the subsequent return gets missed. These are policy mix decisions that I think need to be addressed in the fund governance. I don't know how ValueAct might approach this. They look at private companies. I got to believe now that pension plans of public companies have evolved now to be the 800-pound gorilla in the room, as opposed to this little toddler that you could kind of have on the side for the Treasury officer back in the 70s to deal with. I mean, we had high-profile problems back in the 70s, but nothing like we have today in terms of the billions of dollars. I'd be kind of curious about what ValueAct might be thinking, whether pension risk or liability risks are becoming more front and center, and where fund governance of those pension liability or pension assets are becoming important. Certainly at the public fund level, it's the taxpayers that are going to need to somehow affect change in the fund governance so that we have better policy decisions. I can't say necessarily what's broken, but I can tell you that lay trustees who don't understand a bond from a stock to some degree are making decisions affecting billions of dollars. And these views, by the way, are mine, not necessarily representative of Callan, but I'm just observing after 21 years of these ebbs and flows of decision making, and we are now at a point where these assets, our retirement assets or endowment assets, are so large that indeed our futures are staked on it, and you want to make sure that the decisions upon them are being made with much more information. So policy mixes aren't necessarily broken. Maybe it's just the handler that needs better instruction and better skills. I mean, those are kind of views that I might that I have that I hope will get fixed before the policy mix indeed breaks.
So I see. Allison, you got mentioned. I see some heads nodding around. Does anyone care to comment or agree on that?
I mean, I can try to respond a little bit. I mean, we do have several large public pension plans as investors, and we've seen the range in terms of some of the large public pension plans saying to us, well, we like you, we're interested in your strategy, but one thing that we feel very strongly about is executive compensation. And if you're going to be on the board of any company that we're going to be investing with you and you're going to be investing with this company, we feel that you need to structure executive compensation this way or don't structure it another way. So we've seen very specific sort of governance issues coming into it, and I have to say that that's very difficult from the perspective of a manager, and in that particular situation we ultimately decided that probably wasn't a good fit for us to have an investor that was going to be involved in our investment decisions or expect to be involved in our investment decisions at that sort of a level. On the other hand, on the other end of the spectrum, we have large public pension plans that are investors who understand and can appreciate, because of the nature of being a large public pension plan, a long-term investment strategy. You mentioned, looking at private companies, we do, but the vast majority of our investments are public companies and being involved in public company boards.
Well, distinguishing between a public fund as opposed to a privately
right,
publicly
okay,
traded private company.
Right, and you're right, we are absolutely private, that's correct. Sorry. But we are definitely seeing this governance, and I think that, we're touched a little bit in some ways on, or we will, I think, a little bit on regulation, but something that's sort of interesting is that with changes that may be coming from Congress in terms of whether or not shareholders are going to be able to put people on boards of directors or nominate boards of directors, I think that's an area where the pension plans, the large public pension plans, can really start to get involved. I mean, I'm getting off topic, but you're talking about, as citizens, owning these assets, what can be done, through the manager or otherwise. But I think it's definitely an issue, and it's happening.
Hey, please.
I'd like to make a comment about, especially about the leverage part in policy, because it's an important component. The first thing is that leverage is generally focused on sovereign bonds, on the futures market. And the reason for the leverage is basically we don't have the vehicles to balance risk properly that we'd like to have. Essentially, when you leverage treasuries in the market, using futures in particular, what you're really doing is you're creating long duration, zero coupon bonds synthetically. If we had 20-year strips in size globally, then you wouldn't need to do leverage at all. It's because that's what you need to balance the risk in equities. And for the policy mixes, certainly true risk parity, which for those who are unfamiliar with it, would actually be to balance the risk between stocks and bonds so you get equal contribution. And at the policy level, that would probably pretty much be impossible. But some amount of risk balancing, just reducing the risk that most plans have, which, Jim, I think you'd probably agree is generally about 90% of the risk budget is in equities. Right. And the general idea is that asset growth will outperform liabilities, and that's why you do that. That's why you put all your eggs in the asset growth basket. Of course, in the last 10 years, that hasn't worked. And so there is a move more to LDI type of activities. And one of the elements of risk parity is actually the idea that it does have an LDI component to it. And so because of that, it's not strictly just a return maximizer, even though we believe over the long run it does actually improve the Sharpe ratio of the fund to do this. But it can be applied in a limited way. You could, for instance, reduce the risk of a portfolio from 90% equities down to 80% with some allocation to a leveraged treasury portfolio. And when you look at leveraged treasuries, of course, the risks are quite contained, because I know there's often discussion about the risks of leverage, and typically the discussion goes to leveraging like credit bonds or something like that, and that type of leverage, of course, would be very difficult to do, particularly at the fund level because of the counterparties and all the other issues. But leveraging in the futures market, on the other hand, using treasuries, for instance, is quite doable, and as long as you don't risk it 40 to 1, leverage of 40 to 1 like a certain hedge fund back in 1998, you generally won't run into any really strong issues.